Well, let's bring in Barings Chairman and CEO Tom Finke, who says in the near term things may get worse before they get better.
Thank you.
Welcome to the programme, Tom. All right, worse before they get better, but...
I don't know that I necessarily said worse than before they get better. I think what you have to look at in terms of the trade negotiations is that it's just it. You're in the middle of negotiations, and today you get some positive news in terms of the negotiation on trade between the U.S. and China. And, slightly more, but not unexpected.
But 200 billion seems to be such a nice round figure, doesn't it? It's very,
these are arbitrary figures.
Exactly, and this is what skeptics are saying. How do they do that? There are certain ways you could be including things which are invisibles, perhaps, such as software, that can add something. But is there a problem in the way that we make these calculations?
I think the problem is focusing too much on a number and not on the context. What you got to do is step back and look at the context. There's a negotiation going on, and it's bilateral. In the absence of negotiation, that's when you get in real trade war, when there's unilateral sanctions and no negotiations. So I would argue that you could pick apart these numbers. I don't know if they will really matter in 3 to 5 to 10 years, but at least now there's a productive negotiation. And here's the key. The U.S. and China have to trade. They're interdependent. And so at least a productive negotiation is better than none.
Yeah, I mean, if you focus just on the fact that these negotiations are continuing, it feels like markets are putting this to the side for now, right? And putting geopolitics to the side as well. They're focusing on the market fundamentals and how, whereabouts we're in this late stage of the cycle we're in. Do you think there's a bit of mispricing or naivete going on that all of this is going to ultimately work out?
Certainly, I think the markets, a lot of the global equity markets have become a little desensitized to geopolitical sound bites and news. You really have to step back and look at the fundamentals. That's what we do at Barings. Whatever market we're looking at, we tend to stress the fundamentals. We pay attention to this news, and you can debate the impact of certain outcomes, whether it's trade or other geopolitical elements. But the fact of the matter is, you have to look at fundamentals, economic fundamentals, corporate fundamentals, when you're making investment decisions in any market.
You look at the fundamentals, and particularly I'm thinking with regard to emerging markets. For the longest time, the narrative was kind of, this time it's different. We've got a number of economies that have done, the hard yards when it comes to improving their financial structures and getting their financial houses in order since we had the taper tantrum. Is that the case? Because it seems to be quite a bit of pressure coming down now.
Well, certainly a lot of countries have responded to previous issues, whether it's their governmental structures. You can look at the case of Argentina, where things have improved dramatically over the last decade. But there's also just the natural momentum of the new economy. China is a much bigger player in the technology space. It's critical to the global technology trade. And so those elements are driving a lot of growth in emerging and developed markets, which is a little different when we also see certain traditional industries go through disruption. Take retail as a good example, where there's a significant disruption for traditional retailers in certain markets.
The opening up overtures that we've seen over the past few months, it really has accelerated from Beijing. What kind of impact do you see that as having on your business? And maybe instead of impact, I should say, what kind of opportunities are you identifying to move in?
Well, Barings has been in the Asia-Pacific region for a long time, here in Hong Kong for a very long time, for decades. With the opening of the China market, it's only natural that we expand our local-to-local asset management into China. We expect to expand throughout the region, but right now our primary focus is establishing a more immediate presence in the local markets in China and taking advantage of the fact that we have a heritage in Asia as an asset manager, and to be able to expand that to that growing market.
Tom, it's a huge opportunity for you, China. Many people have seen this, of course, many years ago. Asset management, one thing, but I just want to get back to what we were talking about with regard to trade.
Yeah.
And thing is about manufacturing. It's regarded as being, of course, the be end and end all. But just going to go into the GTV library and have a look at how, since 2013, how much product value is added to a good when you make it in China. And it's gone from, I think, 25% probably in about 2008, 2009. We're looking at about 7% now. The world has changed.
Sure.
China's changed.
Well, a lot of what we consume are services. They're not made, if you will. And
Exactly.
A lot of manufacturing, you used to take 1,000 people to make a car. Now you take less than 100 to run a assembly. Yeah, probably two.
To operate the robots.
2 and 50 robots,
Yeah.
right? So that's the elements. If you go back to the Industrial Revolution, it changed when the engine came in and when mobility came in. It changed the way
Spinning Jenny.
Exactly, and electricity, for that matter.
Okay, there's one question I would ask you, which is, you have been operating in China. Is there a bit of advice that you would like to give to somebody who wants to open up and enter the Chinese market?
I think first and foremost, you have to be serious and look at it as a long-term commitment. You're establishing presence not just in China, but the region. I think it's very important to decide you're going to become a regional player, which we already are, but also that you're going to invest in the infrastructure, recruiting and building local staff with the expertise that you need in that market. So it is a commitment. We are very comfortable with that commitment. In fact, we have a number of our colleagues who look to move over there from their existing positions. So for Barings, we're committed to the region, so it makes it easier to make a long-term commitment to China.
Asset management in China is still fairly nascent.
Yeah.
It has a lot of local players there.
Mm-hmm.
How do you deal with that? And are you confident you can perhaps be standalone there, as the promises have been?
I look at it this way. In the U.S., you have a market where to grow, you take share. In China, you have an opportunity to establish a presence in a growing market. So in many respects, there's opportunities certainly for a number of firms, both of Western and Eastern origin.
Acquisition targets, Tom? Anything that you're eyeing, or any particular segment that you're eyeing at the moment?
In the past, we've looked at opportunities that would add specific capabilities in different parts of the world. In the early part of this decade, we executed on some acquisitions in real estate in Europe. This year, I always try to tell our team, let's not bite off too much than we can chew in a year. The goal this year is to complete our effort to establish a presence on the mainland. We'll consider acquisitions which add capabilities, but nothing major.
Tom, I guess a bigger picture question, particularly when it comes to developed market investing, it feels like investors are having this tug of war at the moment in terms of not knowing what to focus on. Is it the politics? Is it the trade? Is it the yield inversion? Is it what's going on when it comes to emerging markets? What kind of strategy do you take in this kind of uncertain environment?
Well, the core of what we do across fixed income, equity, and alternative markets is we're a long investor. We're not trying to time markets. We're not trying to guess a short. We really focus on finding value through the cycle in different markets and different geographies. So I think there are trading strategies where you try to time things. I don't think that should be a core of any investor's portfolio. It should really be focusing on long-term fundamentals and establishing a good asset allocation.
Tom, I know you're not in the business of predicting markets very often, but will we be higher at the end of this year?
Which market?
EM. Okay, let's go US stocks and also here in this part of the world, and we'll take Hong Kong and China as one.
U.S. stocks we think will perform, but at a lower rate. I think it'll be a positive year in the end. We actually favor emerging markets both on the debt and equity side, as we felt they were undervalued in previous years while the developed markets, especially the U.S., ran up. So we see them, like last year, outperforming developed.
How does oil change the story, Tom?
Well, in the short term, it's obviously the prices creeping up. That's more based on geopolitical speculation, if you will, on what may or may not happen in certain parts of the world. It's certainly, I don't think we would view this as sustainable at 80 without further indication that supply and demand are changing dramatically.